All right, so there's a lot of breaking news out today around the Iran conflict, right? We had the breaking news, President Trump considering suspending federal gasoline tax. Of course, this to mitigate gasoline prices. Also, and that was from CBS News. A tax currently, by the way, adds about 18 cents a gallon, so it would be significant. Also, President Trump is considering renewing Project Freedom. Remember, that's in the Strait of Hormuz. The military operation would be used to establish eventually an escort for merchant ships of other nations through the strait. This, of course, after the White House rejected Iran's proposal as being unacceptable yesterday. In his most recent publication, my next guest talks about these kind of things, the walls of worry, if you will. I'm going to bring in now Federated Hermes Deputy CIO of Equities, Steve Chiavarone. Steve, we have a picture of you and Stephen Auth, and we know Stephen Auth, it's official. He's going to ride off into the sunset in September, and you'll be taking charge. I just wanted to say I love both of you guys, so it must be a great honor for you to follow in his footsteps.
Thank you. It is. I was raised by Steve in this business. He's like a father to me, and wish him the best when the time comes. Going to enjoy the months we have together still, but congratulations to Steve.
Yeah, hopefully we'll get him in a couple times before then. So let's talk about this market and the walls of worry, because the irony, I guess, of all ironies is this rally began just as crude oil prices were going parabolic in the war. We were in the throes of the Iran conflict. And so for many, it's just sort of counterintuitive that we could have rallied this much. Is this just another example of climbing a wall of worry?
Yeah, look, markets don't wait for bad news to become good news. They just wait for bad news to be a little bit less bad. And I think that's the story here. When you had that initial ceasefire announcement, the market said, okay, well, what comes next? And what comes next, and that's really the focus of this piece, is a backdrop that's pretty good, whether it's earnings, whether it's economic growth, whether it's the labor market. Well, it's a pretty good setup.
So before we get to that, then what about the other breaks? Because, with this comes the threat of inflation. With this comes, some of the other things out there. I mean, how can the market not just look through them, but use them as stepping stones?
Well, look, the way you climb a wall of worry is it's never quite as bad as the bears imagine when it's first, enumerated, right? So yes, headline inflation numbers are up, but core readings are not. When you look underneath, yes, there's some transition mechanism on oil prices, but what people forget is that rent prices are coming down, and because they operate on a lag, that's a powerful disinflationary force. So you look at the core reading, it's still 2.6, 2.7. Right. It's not really accelerating. And so that's the point. These concerns sound really scary until you start to look at them, and the market kind of marches through them, and they provide the grease that keep the wheels of the bull market going.
And that's why I tell people, respect the market. There's so many brilliant folks out there. The market's wrong and they're right. Okay, let's talk about another thing now.
You can be right or you can make money, Charles.
The earnings season, right? The earnings season was great. Stocks went up, and even though stocks went up, the earnings season was so great, PE ratio still came down. I mean, that to me has sort of been the one real wild card here.
So this earnings season has been better than great. I haven't seen an earnings environment in the 20 years I've been doing this that looks like it does right now. We came into this year with earnings forecasts that were well above the street, and we've been passed twice already by the results and where the estimates have gone. Margins are growing at a faster rate right now than they did during the dot-com boom. It's really difficult to sell a market when earnings are growing at that clip. That's why the market's not getting caught up in the headlines. It's the earnings story.
The next big thing would be midterm elections. So if history repeats itself, we're going to start sloping into midterms. We'll be down a lot, down on average 15%, and immediately rebound over the next year almost 40%. You tell people to sell and ride it out or ride it out?
I think you ride it out because, one, we may have already had that pullback. Right? That may have been the pullback that we saw, in February. We'll see if we get another bout of volatility. At some point, you probably need to pull back. I do think on the other side of the midterms, though, that pattern of strong returns is likely to be in place. There's a funny thing about midterm elections. Not one of them has ever led to the end of the world yet, and it's unlikely to happen this time either. And I think you do have a setup where once you get past this Iran conflict and energy prices start to come back down, now that tax cut is felt, now you've got inflation coming down, and I think that does fuel another leg of the bull market.
I know you like Amazon here for all the obvious reasons, the chips, the robotics, the Anthropic stake. I'm going to pull up Samsung for a moment because you also like Samsung here now. We just talked about some of these some of these memory names have done extraordinarily well. of all the major stocks in Asia, only one has a lower PE. So on one hand, people are saying, well, the stock is already through the roof, but you're essentially saying it's still extremely cheap.
Yeah, so two things. One, we made the decision last week to reduce our exposure to IFA, particularly Europe, because they did not rebound as strongly on the ceasefire.
Yeah.
They've got a lot of vulnerabilities. We added to large cap growth, that's Amazon, and we added to EM, and that's Samsung. Look, these companies traditionally trade on low PEs because they're very cyclical businesses, but they're sitting as a key shortage in the biggest infrastructure build out since the railroad. That's more of a secular story, and at 6 times earnings, it is the relative value. And you can lose a lot of money or not make a lot of money in this business by getting scared out of a big percentage move on a stock that's still cheap. We still think that there's quite a bit of upside here.
Great stuff. Congratulations again. And you set me up for later in the show when you say railroads.
All right.
That's what we call a tease, my man.
There you go.
All right.